Our final one today is going to be, well, before our closing keynote, it's going to be on scaling DeFi with stables. And our head of partnerships lead, Illia, please join us on stage as the moderator. And then, our gentlemen, please come on up. If you can just join us from left to right based on your names. Chase, Robert, Garm. Oh, wait. Yay. They really did not think it through giving me a mic this long.
All right. Final panel, scaling DeFi with stables. Thanks everyone for being here. My name is Illia. I lead partnerships at Aleo, and today I'm joined by apparently 3 experts in stablecoins. Do you guys want to introduce yourselves just to set the stage?
Yeah, I'm Chase. I lead product at Brale. We're a stablecoin issuance and orchestration platform. We help businesses create their own stablecoins and then have a unified payment rail for moving money around the world.
Three. Here we go. So, hi everyone, I'm Robert Horwath. I'm a founder of Payper. We are creating a private stablecoin on the Aleo network.
Awesome.
Cool. I'm Garm. I'm CEO of GloDollar. We are a customer of Brale. Love the platform, personally. We're a stablecoin much like USDC, so US issued, US regulated, 100% fiat backed by a mix of cash and US treasuries. Big difference is we are structured as a non-profit, and that means that we take all of the money that we make and we donate it back to the crypto ecosystem to builders, typically through grants for builders on the chains that we're on. We're also experimenting with a new product that's going to help scale stablecoins in DeFi called Spinach, where we basically say liquidity incentives are a big thing for liquidity providers on a lot of chains and DeFi platforms now. We say give it to builders instead and let them orchestrate the liquidity. And in our first experiments, that's been super successful. Excited to talk about more.
Thank you. Excited to have you all here. Probably to begin with, I want to ask you guys a question. So we've been hearing for a while that stablecoins are really the only product in crypto that has found product market fit, or so they claim. What is your take on that, and why is that of such an importance specifically to DeFi? Chase, maybe you want to.
Yeah, I think at a high level, we're a few years into this 10 to 15 year arc where all of finance, all of assets will move on chain. And as we think through, payments, settlement, Forex, securities coming on chain, all of these rely on stable coins really in some form. And this is something where if we look today, last year, stablecoin settlement exceeded really Visa settlement. This is really something that's happening now today. We have the chain infrastructure. We have enough stablecoin enabled FIs today. When you layer on regulatory, I'd say this is something that we pretty much made it. I'd say privacy is probably the last primitive to get there, but it's a really exciting time to be building in stables.
Interesting. Anything to add?
I absolutely agree with you about this. I think part of the financial system is going to move to crypto. And I also think that there are several consequences of this is going to be. Like in the previous session, I agree that one of the future of this system is going to be that there is going to be a layer on top of all the chains that gonna hide from the users where they are sending money actually, because they don't care about it. The second thing I think is going to be another happening, which is a bit more sad thing, is that projects are going to drop out. Because there is this ongoing waves of crypto summers and crypto winters, and the crypto winters are going to be pretty cold for a lot of projects. And I think on the medium or longer term, this is like a natural oligopolic market where a few are going to survive, providing the best services to the users. That's what I think.
maybe some additional thoughts. I think historically, stablecoin cumulative market cap has been growing like 107% year over year. I don't see any signs of that slowing down at the moment. So I think that's a great indicator of product market fit. Other than that, I've been saying for a while now, we're slowly seeing stablecoins in particular replacing the TradFi financial stack. And I think the previous example in the previous panel that was given of Robinhood is a prime example of that. And we'll slowly see that occurring more and more across all of the big fintechs.
Awesome. I think we touched upon quite a lot of important topics, and I'm happy to get back to them. One thing I wanted to follow up with you, Chase, on, it is true that stablecoins, global settlements have surpassed Visa in the last year. How much of that do you think is an actual volume as compared to just wash trading or just exchanging one asset into another? And can we actually trust that statistics?
Yeah, I mean, there was, when the data came out, right, a bunch of people argued with it, and there are a bunch of different kind of lenses on it. There is a lot of sort of volume in wash trading. My kind of point of view, though, is like, no matter how you slice it, the volumes are growing very quickly. And it's very clear with the growth rate that, you know, within a few years, you can also see recently, right, things like Bank of America coming out with their own stable. You know, JP Morgan is quietly doing billions per day in volume in their stable. And I think if you just look at the momentum now post the administration change, things like the Genius Act, it's very clear where we're going, right? I mean, we're biased and we see this all the time, but we're in an environment now where pretty much every fintech is talking about stablecoin strategy. It's you know, we're almost in that like early part of the S-curve adoption where there's almost like FOMO into stables at this point. I do think that maybe to come back, right? The folks at Visa did a really good job though, pulling back the data. I do think it's important to look at this and you know, be really careful with how we slice the data. But overall, I think we're super constructive on where we're going.
Yeah, definitely agree that the growth is there. It's just a matter of applying it to the right place right now. Anything you wanted to add?
I would like to give another perspective to where we are at. So the total value of the stablecoin market, like the stable coins, is around a few $100 billion. But the total money supply only in the United States is $18 trillion. So we're talking about 2 orders of magnitude difference between the stablecoin market size and the money won. So this is actually the smallest money supply, M1, only in the United States. And the United States is, let's assume it's about 20% of the global GDP. So if you multiply by 5, so you say that it's about 100 trillion worldwide M1 money supply compared to the few $100 billion. So I think there is a way to go. And I'm pretty sure that this market will be very volatile in many ways until we get to much closer to the M1 supply.
Interesting. We've covered quite a bit on why stablecoins are so pivotal for DeFi and in general how they found the product market fit. How about we talked a little bit on the challenges that stablecoins see right now? Apart from privacy, which we'll cover a little bit more in depth later, any obvious obstacles on the way to truly mass adoption for stablecoins?
I'm going to think about that for a second.
Okay, I think there is 2 major issues. One of them is currently the overall network speed, like how many transactions we can do, and the other one is the fragmentation of all the systems. To me, actually, it looks like, and I'm sorry to say that, but I'm a bit pessimistic about what was going on in the past 10 years. So ever since we've done things at Maker at 2017, 6 years have passed by, and the supply of Maker is about $6 billion right now. And I think that compare it to the money supply or any other thing, this is something that was a kind of slow evolution. And I think one of the key reasons was the small throughput of the Ethereum ecosystem so far. We will see how the layer 2s and how the overlay networks are going to help with this.
Interesting. Garm, anything to
Yeah, I'm just thinking super pragmatically, something we've probably been challenged with most is just being able to very narrowly provide stablecoin liquidity on DeFi protocols. Like a lot of the DeFi protocols just aren't super capital efficient yet. And I think for the large stablecoins, that's probably less of an issue. But for us, it definitely is. On the other hand, also if you look at the large stablecoins, like there's a lot of capital being tied up that isn't being super productively moved around, and the liquidity providing fees that you actually earn through most decentralized exchanges aren't really great. So you get these sort of patches on top of it to get whales to provide actual assets within these trading platforms. I think there's probably a lot of opportunities to do that better too, but I don't have the solutions just yet.
Interesting. I want to spend some time talking about fragmentation. So now there is around a dozen different mainstream stablecoin issuers and around 100 maybe even kind of up and coming new ones on the block. And if we kind of multiply that by around like 15 mainstream chains that everyone is on, then we get like roughly 150 versions of stablecoins that you and I can receive and between each other. And some may even say that's more than the fiat currencies that we might be having in our pockets. How do we deal with this? And is this even a problem, quite frankly? Maybe Chase, as a Braille representative, or helping us get more and more of different stablecoins, you can give us your stance on this.
Yeah, I mean, I think there's a few layers of fragmentation. One is obviously at the chain level, right? There's an explosion of chains. If you sort of believe in the app chain thesis, which seems to be growing right now, you just have more fragmentation. I think that we have things like Layer 0, Axelar, a number of cross-chain protocols at this point, and there are a number of teams now building on top of them. We're not there today, but I do think in like 1 to 2 years, we'll start to think of more unified liquidity. So if you think about today as a new stablecoin, I have to see liquidity on every chain. It's extremely hard. Even USDC and USDT have struggled on certain chains, which is insane. So that's one. I think on the like per asset fragmentation, you see this a lot with local currency stables. They're hard to get going. A lot of people talk about this long tail of currency stables, but they're very hard to get going. I do think though what we see is there are many flows where if you need to exist like in an open protocol way, it's very hard to compete with USDC and USDT. You can do it, but it takes a big budget. In a lot of these fintech flows, they're more of back ledger stablecoins where you don't necessarily need broad liquidity. And so I think we see that at least sort of at Braille. I think you will see a long tail of stablecoins maybe that aren't competing or they're not really serving the exact same use case that we talk about with like a USDC type of stablecoin.
As a contributor to this fragmentation, it's definitely a problem, and it's also, I think, more a perceived problem by users than a real problem. Like a lot of our like the communities that we try to reach will often bring up like, oh, but is your liquidity good enough? In practice, it is, despite us only having like a TV depth of 100K on most we're able to facilitate most of the trades that people are trying to do. That said, I think there's also an opportunity here. I mean, if we have hundreds of stablecoins out there with fragmented liquidity, then there's probably an opportunity for a business to start taking all of those and start making some bips on actually settling between all of those stablecoins and the businesses that want to take them.
And there is another thing, is that this technology, the very technology of stable coins, especially the algorithmic and collateralized stable coins, make it possible to actually simulate any asset, not only like the very stable stuff like we call dollar or some currency in the world, but they can actually simulate anything that has a value behind it. For this reason, I think this will lead to proliferation, and I agree with both of you guys that there is several things going on, but I think on the long run, this is going to, that like the same thing is going to happen to stable coins as with blockchains, is that the crypto winters are going to take some of them each and every time, and this will lead to another oligopoly market of stable coins because of the economics of scale.
Interesting. In this oligopoly market, what would you say is the main competitive factor between different stablecoins and different chains? Is it primarily yield, or is it something else on the utility end?
I'm an engineer, so the first thing I like to think about is always tech. So I'm pretty sure that speed will matter on the long term. I think also privacy, and especially programmable privacy, will matter on the long run. So those protocols who can have an answer, can address these two, are going to want to lead. And we also have to take under consideration that there is a current situation. So there are some projects that already have gained enormous traction. And I do believe that some of those projects are the ones that are going to be there with us on the long term.
Awesome. Yeah, I definitely agree. And I think we've touched upon privacy enough times right now, so it would be almost rude for me not to ask this question. What is your guys' take on private stablecoins? Is this even a real thing when we talk about mass adoption? Is this even going to be allowed, or are we just talking about tornado cash at this point?
I have a deep desire to live my life in stablecoins, but I do not because they're not private enough yet. So yeah, I think just for my own personal reasons, very much necessary. How it's actually going to work, I don't know yet, but I do see the big opportunity there. There's a lot of talks about privacy also being important for businesses, but I'm not so sure that's that big of a pain point. If we're sort of observing all of the developments that are currently already happening, I think it's more about the mass adoption of individuals, where that's really going to be a prime building block.
Interesting. So you're saying retail users care more about privacy than the institutional ones?
Traders probably do care about it a lot, but I feel like businesses, they don't really mind so much that there's large money movements, remittances going on. Like there's so much traction in that world already, and from what I hear, there's not that much concerns around, okay, we don't want the competition to see that we're moving 100 million between Japan and Brazil today or something.
Interesting. Robert, what's your take on this?
Well, we are pretty much concerned about this part because we are actually building a project like this. Just to give you an overview about this is that the basic thing that these projects have to balance between is adoption and compliance. So the more compliant I will be, like fully transparent, like USDC, for example, then I'm probably not going to have too many users because my whole point is that I give some kind of privacy. And I really like in the previous session, it was mentioned that there is several types of privacy that we are talking about. So there is actually right now some kind of privacy because my person cannot be tracked based on my account address. So that's a certain kind of privacy, but we can increase this privacy. So our project is trying to increase this privacy in a way that your financial data and transactions cannot be seen by the whole public, just the way as you make a bank transfer or something like this. And actually we can also, and this is an ongoing discussion within the company, so how we are going to move forward with this. because what we really like to do is to bring down the privacy level that was now only possible like between banks to the private sector, so people can have a pretty strong privacy aspects of their transactions.
Interesting. I think maybe it's also important that we differentiate between privacy and confidentiality, right? So are you guys concerned primarily with private transactions, or confidential transactions are also good enough? What's your take on this?
I'm in a position right now where I can really hardly answer your question, because we have an ongoing engineering discussion about this. There is a lots of
Maybe it would be helpful if we did definitions first, if that helps.
Okay.
Sure. So like, as we define it at Aleo, confidential transactions mask a certain portion of the transaction info, such as an amount, for example, right? However, private transactions are fully encrypted on chain, meaning you don't see who sent it, who received it, and also what was the amount, or even underlying asset, right? So some people would make an argument that, hey, as long as we hide the amounts, the general public, the retail users, would also be kind of satisfied with this, while others say, hey, we need like full privacy.
I think it is. So our question is not this. So we can make full privacy, but the question is towards whom. So for the general public, I can create transactions with our token design in a way that nothing, even the existence of the transaction, is visible to the public. The regulators, it's a different issue, because we can, and this is how this is the part that is not actually decided yet, is that how much we share with the regulators, how much information we share with the regulators. And thanks to this technology, zk technology, we can be really fine-grained. So we can actually say stuff like, no exchange has been done from this address to a certain other address without revealing any other information. We can also say that the transaction amount of this address was below the threshold that you guys were asking for, without revealing any other information. And they can be given mathematical proof that what we are saying is actually true. So we can do pretty nice things in this regard. And of course, we want to make sure that only the information gets out from our system that is absolutely necessary.
Interesting. So there seems to be an agreement across the board that privacy in some shape or form will be required going forward. So maybe we can wrap this up by saying one more thing that will need to happen in the next, let's say, a couple of years with stablecoins for them to have an even bigger impact on DeFi and TradFi and the world in general. Jace, why don't you start?
Yeah, I mean, overall, I think today we have high quality stablecoins, and we have more and more issuers coming in, which I think is great for the market. There's more competition, there's more lenses, we have rebasing stables, we have multi-issuer stables. That's sort of like we're running the IDMA. So I think the stables will continue to see, but they're in good shape. We have high throughput networks. As we can see, we already have a number of these payment flows. You can do, US to Argentina in 2 minutes, US to Brazil in 5 minutes, all this kind of stuff. I really think privacy is probably the main missing primitive. I mean, regulatory would be the other one. I think we're really close to on regulatory, right? Singapore's in a good place. Europe, MiCA, I think Genius Act. I think that's probably the biggest lever. But I would say that for a lot of these use cases at the institutional level, payroll, supplier payments, I do think privacy is there. It's one of those things where, like, I think that gets us really to parity with the traditional system with all the benefits.
Interesting. Robert or Harm, anything to add as a final thought?
I'm personally very excited about non-collateralized stablecoin-based credit. I think that's the next frontier and can be an unlock to grow market cap another 10x. but you definitely need privacy for that. Like, I'm totally fine sending some stablecoins here and there, and anyone can see it. But as soon as I'm going to sort of do actual credit and lending based on who I am and recourse, I want that to be at least private towards all of you. The regulator and the banks can probably figure it out somehow.
Yeah, that makes a lot of sense. So yeah, it does seem like stablecoins allow us to combine the best of both worlds, the speed and the lack of geo-blocking, let's put it like this, of the crypto world, and then the convenience and ease of access of the fiat world. So yeah, thank you, gentlemen, for joining me today. It was great to talk to you, and thanks everyone for joining us tonight.
Yay!
Thank you, Illia.